Self-Amending Blockchains, Arthur Breitman on Tezos Governance Innovation. In this episode, Dr. Jemma Green sits down with Arthur Breitman, founder of Tezos, who's revolutionising blockchain governance through self-amending architecture. Arthur shares how Tezos eliminates hard forks through on-chain governance, pioneered energy-efficient proof-of-stake consensus, and became the unexpected home for generative art and AAA gaming. From governance mechanisms to scaling solutions, they explore how technical innovation is reshaping the blockchain landscape. I'm your co-host Anthony Pearl, and whether you're an investor or a startup looking for insights, it's time to get unblocked.
Welcome to Unblock'd, Arthur. It's lovely to have the co-founder of Tezos Foundation join us today on Unblock'd.
Thank you for having me.
All right. I'd like to start at the beginning. Tezos has been around since 2014, so you're definitely in the OG category as a pioneer in the space. I'd love if you could just tell us about what is Tezos and what was it envisaged as originally and what is it today?
Right. So Tezos is a unique blockchain in that it is, to the extent of my knowledge, the only blockchain that actually upgrades itself on the fly based on the decision of the token holder. So if you hold a Tez token, you can create blocks and you can participate in the governance of the chain. Now, back in 2014, there were a lot of discussions around what should be the governance model of a blockchain. And some people insisted that they should have none, that they should be set in stone and that nothing should ever happen. But I think that was myopic because we've seen 10 years of innovation. Proof of stake has been a fantastic innovation. Smart contracts, privacy, all of these innovations were still nascent at the time, and there's still more to come. And at the same time, other people said, well, you don't really need governance. All you need is forking because the developers can just tell everyone, here's a new version. Now, the problem is that if the developers can tell everyone, here's a new version, you don't really have an immutable system, do you? You're just at the mercy of what the developers want. And Tezos has a formal governance system. It's also the original proof of stake blockchain. They were a chain that used a form of staking in the past, but Tezos was the first one where actually coins were at stake. Like if you misbehave, you would actually lose your coin in a mechanism known as slashing. Pioneer also advanced programming languages for smart contracts that allowed people to use formal methods more effectively in order to prove the security of contracts. So it's innovated in a lot of areas. And as of late, I would say in the past 2 years, the main focus of the development of the chain has been around scaling. So it's a blockchain that's home to many applications, particularly in the art space. We have a thriving art community. There's, of course, games. There's, of course, DeFi. But all of these have been popular in part because Tezos has been able to maintain very cheap transaction fees, some of the cheapest out there. And that has been through a relentless commitment to scaling over time and providing more and more capacity for usage.
Great. You mentioned like a few use cases here, art being a significant one. Could you tell us a little bit about the kind of art projects and ecosystems related to art that are on Tezos?
Sure. So I would say the genesis of art on Tezos really starts with a marketplace called Nunc, Here and Now, which attracted a lot of artists, especially a lot of generative artists creating art pieces from code. And this community really grew. And then we saw a lot of other projects pop on. There was FXH. There's, of course, Object.com, which is a leading platform for minting and selling NFTs on Tezos. We also have AK Swap. So yeah, I'm going to forget some because it's a big ecosystem of this. Largely visual artists and generative artists have found their home on Tezos.
And you mentioned DeFi as well and gaming. Could you tell us a little bit about the kinds of things happening in those regards as well?
Yeah, so we have an exciting upcoming game on Tezos, for instance, called Reaper Actual. It's a AAA game and it's coming to a rollout on top of Tezos. So I'm getting into the technical detail here, but one of the latest development is that Tezos, has a compatibility now with EVM. As you may know, there's a lot of chains out there who took the EVM model from Ethereum and replicated it. And that allows developers to develop for the EVM without necessarily committing to the choice of one chain and then making that trust later. And in that case, so that compatibility layer is known as Etherlink. So any application that's developed for the Ethereum world, whether you develop it for Polygon, Base, Ethereum, all of these chains, you can now run it on Tezos via Etherlink. And Reaper Actual, which is coming in a few months, is one of those. So exciting game in a generative universe.
Nice. I mean, crypto is like constantly in a battle between decentralization and efficiency. Where do you think Tezos sits on that spectrum, especially as projects such as, say, Solana and others push high throughput?
Yeah, I don't think there's actually a big trade-off between, I would say, throughput and security and decentralization. I think for a while, it was not known how to design the systems. And so people would have the trade-off. But I think by and large, the trade-off no longer exists. If you want to get technical, once you have a technology like rollups, be they ZK rollup or validity rollup, which I proposed as a scaling solution in 2017, or optimistic rollup, and you marry that with data availability sampling. So I'm getting in the weeds here, but the point
Sorry,
is,
I didn't actually hear what you said. Could you just say the word again?
data availability sampling.
Oh, got it. Uh-huh.
I'm getting in the weeds here. The point is, I would say around 2021, around 2020, 2021, there was a solution that was known that would let blockchains scale. So I don't think it's at odds with decentralization. Now, I'm not sure what the people behind Solana are thinking, because it's not very coherent. Like, they have this proof of history, which doesn't really do anything. And then they have this idea that the ledger is secure so long as there's a copy somewhere. It's not intellectually consistent. It's kind of nonsense, which doesn't mean that the chain doesn't work, right? But I don't think they have a grand theory of how any of this works. But, I think they're very focused on performance, and they treat decentralization as a secondary aspect. And, it's not an approach that I particularly like, but I am more shocked by the lack of intellectual rigor than I am by the centralization. If they want to be centralized, so be it. But don't go out and say that proof of history is a thing that's useful for a consensus. That's ridiculous.
Got it. And so for projects that are considering like a protocol, and maybe, there's obviously Ethereum as well, what would you say is the kind of compelling USP for projects to choose Tezos?
Oh, it's a lot of things. Out of this community, we have a great community of, I mentioned of artists, but also of developers. It's a good ethos. I think there are people who are allergic to bullshit, and it's one of the ethos of the chain. And if you're allergic to bullshit, I think you find a good home here. There's also organizations within our ecosystem which are happy to support new projects. Organizations such as Tech in London, such as the Tezos Foundation in Switzerland, such as TZ APAC in Asia. And so one good example, for example, is Sony. So Sony is a project that's on Etherlink. They are at the intersection of AI and art. They are a deep in platform for artists who want to use image models, remix them in fun ways, or like provide compute for the network. And Sony came in via, one is that I think they were attracted to the community of artists that was existing on Tezos, and two, there was also the connection with TZ APAC. So it's a holistic. I would say it's for holistic reasons. There's also the fact that it's a serious place. It's secure. The chain has run, securely without interruption since 2018. And, the future is assured in the sense that it's always upgraded. It's always been at the forefront of technology. And so you're not going somewhere that's going to disappear or there's going to be a flash in the pan. It's not the sexiest, but you also know that it's not riding like a hype crest.
Got it. I mean, to press a bit further on that, you could say like Ethereum has some of those characteristics. What would be the difference? Is it speed that you would say, or like what would be the differentiating factor between choosing it like Ethereum or Tezos?
I would say, speed. Transaction costs are much higher on Ethereum. Ethereum has not really progressed on a technical roadmap. I think a lot of it has been outsourced to rollups, but all the rollups that you have on Ethereum contrasted to the one on Tezos are custodial, and that's a big difference. So if you're using Base, if you're using Arbitrum, if you're using all these rollups, there's a set of key that can steal all your assets. Coinbase has complete control of Base. There is no difference between a DeFi deck running on Base and the order book at Coinbase. It is 100% under the control of Coinbase.
Yes.
And I think it gives rollups a bad name, but that's not the case for the rollups on Tezos, which are actually decentralized. There's nothing inherently centralized about the rollup technology. It's just that the people who have built it, as this kind of for-profit ventures on Ethereum have done it in a way that's been completely centralized. I also think that they're responding to the market, which doesn't really care all that much about decentralization. It's not everyone, but I think by and large, like where the money is not necessarily in decentralization. And also people don't know. I think a lot of people assume that when they're building on Base, they're building on chain and not on a database that's 100% controlled by Coinbase.
Yeah, like it's a private consortium, not even consortium, it's just a private chain.
I mean, it runs on Ethereum, but the point is, if you have, if Coinbase has a key that can completely alter the chain, the state of the chain, I guess, it's better than a private database in the sense that you are, at least, it's tamper evident. It's not tamper proof.
Yeah.
It's like if they do something, everyone will see, but which is already improvement, but they can still do something.
Yeah, I see your point. From what you've just said there, it sounds like another point, which is that people within the Tezos ecosystem also have a good sense of humor.
I hope so. I hope so. I try to.
Yeah, I want to kind of piggyback on what you said about being allergic to bullshit. I would say that Tezos really rarely chases these short-lived crypto metas. Let's say, for example, the revenue meta that everyone is chasing right now. Is that restraint driven more by your long-term thesis for Tezos? Or is it because of a skepticism that most metas are just cyclical noise?
I mean, the revenue thing is a lot less bullshit than most of them, right? If indeed your chain, if you need a lot of tokens end up being burned because you have a constant demand for, you have constant demand for the tokens because people want to transaction and those end up burned, that is a very, very valid model. It's one of the most valid that exist out there. It's stronger than just being a store of value. So I do think store of value is meaningful. And it's stronger than being means of payment. The problem with it, because I think it's going to be very difficult for chains to raise significant revenue. And the reason behind this is that, as I was saying earlier, I think scaling is solved. It's a solved problem. It's not necessarily like we don't have systems that's perfectly scaled right now in terms of engineering. I would say as an academic problem, it's solved. As an implementation problem, there's still work to be done. But imagine now that all the blockchains scale and you have abundant block space, you have abundant transaction capacity. People can do 1 million transactions per second everywhere. Where does the revenue come from? I mean, people might make transaction, but the clearing price for transaction is going to be zero. If you have if you go by an auction mechanism or such, because I don't think we are in a world where the demand for blockchain block space is going to exceed what can be provided. I think we reached that world when Ethereum, back in 2021, Ethereum was doing lots of revenue because, hey, they were doing like a handful of transactions per second, and those were very important. Now Solana, with much higher transaction throughput, I still managed to make a lot of revenue for the transactions, which is quite impressive. The question is how sensitive are people to transactions? And you can imagine something where you have chains that have transaction fees which are not zero, but which are low enough that people don't care, but high enough, there's enough volume that they make money. So I think it's still possible to have revenue, but it's a tough one. It's also interesting to look at the funnel of value. So imagine someone who's doing a swap on a blockchain, and let's say they're doing it on some random EVM L2. So they might pay a fraction of a cent in burnt tokens as transaction fee. And then, the DeFi protocols they're using, maybe it's, keeping 10 basis points, 5 basis points in some form for the swap. That's already way more than the thing. And then, they happen to be using MetaMask to do it, which charge them 75 basis points, and they're lazy and they don't care. So I think the value is going to be captured by the players who have distribution channels, which are going to be wallets and exchanges, are going to be able to extract a lot of values, especially if they can abstract a backend. If you often hear sometimes people say especially people who, like myself, have built blockchain, say oh, the future is you don't even know you're using a blockchain. It's, completely underneath. And that may be true, but that is not a desirable future for people building blockchains, because they want to have brands. They want their chains to work. You have the strong network effects to work as strong distribution channels. And if behind the scene, everyone is just using application and they have no idea what blockchain they're using, then those applications are going to be the one paying the transaction fee, right? If the future is use some kind of broker and the broker uses a blockchain under the hood, if they can switch from, if they're making billions of transactions and they switch from a place that gives them 1 cent per transaction to a fraction of a cent per transaction, they're going to go to the other one. So you have a race to zero. So the revenue thing, I would say it's not impossible, but it is iffy. But it's certainly a better meta, I would say, than memes or others.
And if you talk, metas are always kind of also questioning sometimes beliefs that you stand for or that you have. When you originally came up with the Tezos protocol. Is there any belief that has changed recently where you're like, okay, maybe I was on the wrong track back in 2014?
Yeah, I think in 2014, I mean, in 2014, there's a few, well, more than a few mistakes that I made. But the main thing that I was wrong about was the importance of scaling. Essentially, I thought that most scaling would be done via channels. So things like Lightning and others. I thought that the primary use case was being digital gold, because in a way, that thing that's more defensible than the revenue meta. I thought the main use case was being digital gold, and as such, you don't really need a lot of transaction, a lot of capacity. It's nice to have smart contracts. And so I didn't focus on throughput or compute very early on. In fact, even the early languages in Tezos, they're made for saying like, hey, you're going to have a very, very secure language for doing channels, for doing multi-sig, this type of thing, but not necessarily for building very complex application that run directly on chain. And that was renovated later on. That was one mistake. I mean, it is and it isn't, because in a way, I still feel like the narrative that's the safest is digital gold for Bitcoin out there. I don't think that Bitcoin is inevitable. It definitely is in a better position today compared to others than it was in 2014, 2012. In 2017, we got very close to flip of Bitcoin via Ethereum, and I think that would have had massive consequences in people's psyche. And I think it can still happen between like a large, I'm not saying, I don't know if it will be Ethereum or something else, but it is possible. And I think they would shake a lot of confidence in the assets if it does happen. And I don't think the dominance of Bitcoin is completely set in stone, although it is safer today, much safer today than it was a decade ago. What else did I miss? I wish I had stumbled on the roll-up design earlier on. I think there was something very, very strong here. I had some ideas around validity roll-up, but I was missing aspects of data availability. The other thing that was very surprising. So Tezos has a smart contract language, again, that's very focused on security, because my thinking was you're going to have these small contracts that controls hundreds of millions of dollars, billions of dollars. And so it's going to be very, very valuable to make them secure. And, the systems that are there are insecure. It was correct that small contracts written in EVM, whatever, were going to secure hundreds of millions of dollars, and that they would be insecure, and that they would be hacks. But I did not see that people would not care. Like, by and large, people do not care about security. Like Wormhole exploited for 600 million, all of this constant exploit. And yet the market does not want security. And I have one theory for that. The theory is like, if your main use case is someone buying a token and saying, oh, I have 1% chance that this token is going to 100x, and I'm buying a lottery ticket. If that's your main use case, if you tell that person, well, you don't really have a 1% chance of it 100x. It's actually like 1% minus the 0.01%, because there's also a small chance the contract is going to be hacked. They're risk seeking. They don't care. In their mind, their money's already gone, in some sense. So the demand for security, I think, will come with more like less gambling focused applications. And right now, the most profitable things out there are beamcoin trading or perps trading, and all of these have to do with like massive amount of risk. And I think the corporates care more about security, but it's still been a very tepid in the space. So yeah, I was wrong about the importance of security. I don't think I was wrong about the way to achieve it, but I was wrong about the importance of security. People care far more about developer experience than they do about security, like far, far more. And I was wrong about the importance of scaling earlier on.
Great.
Yeah, can I jump in and ask you something about that you were talking about a little bit earlier on, is in regards to community. And I'm just fascinated by how important community has been for you and how much you've fostered that, and that gives you a bit of an edge.
Yeah, but I would say every blockchain fosters its community. And so, the bigger, stronger, more vocal your community oftentimes, the better. And it's the way I describe cryptocurrencies sometimes. They're not exactly, they're ledgers, but they're a bit more than ledgers. The closest thing to think of them is as online communities. And even sometimes, when, trying to like looking for executives to hire and such, you talk to recruiters and they imagine like, oh, you're in the blockchain space, so let me find you some people with experience in fintech. And it's like, on a day-to-day basis, it looks a lot more like, again, online community management or sports club management than it does fintech.
Interesting. So do you think that it's an important way to help, growing ideas and things? Is it important to maintain it and foster that?
Yeah, absolutely. You want a very strong user community and you want a very strong developer community, because What a lot of people did and are still doing is platform plays for blockchains. The idea being that build your application on a chain because we have all these users, all this community who wants to use your application, and vice versa. Come and use application on that chain because we have all these cool applications for you to use. Now, I think that's threatened by the fact that a lot of applications are multi-chain and the fact that wallets are going to abstract that. And so in some sense, people are still users of blockchains. I think like there's some people out there who say like, I like using, Tezos, I like using Near, I like using that blockchain in particular. And there's a bit of a loyalty towards blockchain. There's a bit of convenience, but more and more people are going to see themselves as users of wallets. Like, I use this wallet. And then, behind this, the wallet has a swap function that's integrated. It routes through all the different chains, find the best liquidity. And that compresses the margin of anything that's underneath it in the stack.
Arthur, I want to just delve a bit further in your kind of retrospective of your theses and your time in blockchain. When you wrote the white paper for Tezos back in 2014, on reflection, are there things that you would have wanted to be articulated differently?
So the white paper was written by L.M. Goodman.
I don't know. In terms of insights, do you have any?
In terms of insights, but hindsight is 2020.
When I said you, I meant as in Tezos.
Yeah. I mean, hindsight is 2020. What do I wish were in the Tezos white paper? I can give you a cheeky answer. I could say like, hey, you can have very powerful AI systems by using transformers and deriving scaling law by training them on very large amount of data, and then you can use RL on math problems to get them to be reasoners via chain of thought reasoning. I'm kidding. You could cram like the past 10 years of innovation in there and say it was there. Now, sorry, I'm just being cheeky and literal. What could have plausibly been there and wasn't there?
Yeah, I think that's true. Yeah. And I do like the humorous response as well.
Yeah, what could have plausibly been there is scaling. I would say, like, I think roll-up style scaling could have been
I may continue with, because scaling is obviously such a big topic, and I think a lot of the current brain power is focused on Etherlink within Tezos. I noticed that for Etherlink, there seems to be a much stronger focus on DeFi and growing out the DeFi ecosystem, as was the case for Tezos in general. DeFi being like one of these areas where I would say critics would argue Tezos has never really taken off.
Yeah.
Is that something that you think you would have focused on earlier if you could go back in time?
So just to finish my answer to the first question in the white paper, and I'll address the DeFi question. So white paper, I think scaling and a bit more privacy. We do mention privacy in a paper, but scaling would have been a good one to tackle on, and one that could have plausibly been there, like focus on a pure consensus and staking layer, and then later on bolt on a really high efficiency design, which is the design we're using for Tezos X at the moment. DeFi didn't really take off on Tezos in 2021, and there's a story behind that. So I did think that DeFi was quite important. We had a rocky start. There were organizations involved in trying to grow the Tezos protocol, even starting in 2018. But I had a bit of a distant relationship with them. And so I tried to impart some momentum, but in a lot of cases, I was unsuccessful in imparting that momentum and imparting that urgency. So I became aware of Uniswap when the paper came out. And, I come from a market making background, and I thought, hey, this is simple to implement. We should get this on Tezos. I communicated that, and somehow it turned into a ridiculous 1.5 year long, $1 million cost boondoggle. And so we were late with that, and there was a coherent strategy around DeFi, but it didn't really pan out. Then 2021 comes around the corner, and then we have the most aggressive administration in the United States against crypto. And the thing to think is, like, a lot of people are focused on securities law around everything that has to do with crypto. And there were theories being put forward by the SEC, theories which, have not panned out in courts because they've lost a lot. And now, which I think are being clarified with the Clarity Act in the US. But there's more to it. You're pulling a lot of money without KYC in a DeFi pool. So there were also, I would say, threats from FinCEN, threats from OFAC around DeFi. It was not a given that DeFi was going to survive this administration. And there was certainly a lot of risk. So the Tezos Foundation did sponsor some DeFi projects to go on Tezos. But, for example, we didn't try to launch in-house DeFi protocols. There was no desire, for example, to provide liquidity inside of DeFi protocols. So I would say there was an approach that was quite prudent given the onslaught that was happening in the United States. And the other thing is, like, I thought at the time that DeFi was going to be won by a centralized system. And I'm very surprised that Binance Smart Chain did not win DeFi, for instance, because they had a few things going with them. One, they had enough performance and low fees. So people might care about that. They had centralization, but by and large, people who are using DeFi, they care if it works, but they're in a transaction for a minute. They're not building something that's supposed to last 10, 20 years. If you're minting a piece of art, centralization is super important. You want your art to be there for the next 10, 20 years. You want it to be credibly neutral, all of that. If what you're looking is a cheaper way to trade your Bitcoin for ETH, or your Tez for USD or whatever, you don't really care about decentralization. It needs to work in the next half hour, but it doesn't really. So decentralization was not a huge factor for it. A bit different in lending than trading. Cost was quite important. And then not only did Binance have, a fast system, they also had all their distribution channels. They basically, anyone who's interested in trading tokens was, had a Binance account in some way. And so they had all this distribution and they could wrap every asset. So every asset out there could be wrapped in their chain. They still didn't win DeFi. I find that very, very surprising. I also saw, there was a lot of very unsuccessful attempt to foster DeFi in other ecosystems. I saw a lot of foundations spend hundreds and hundreds of millions of dollars bribing liquidity to come in. And as soon as they stopped doing that, the liquidity dried out. The only chain that pulled it off was to some extent Polygon. Polygon managed to retain a lot of liquidity after. I think Avalanche kept some, but it's been very hit and miss. It completely fell for Algorand, for example, lost a ton of its DeFi after they stopped paying for it. It was also very commodity. There was not a whole lot of innovation in DeFi. People had DEXs and then people had lending and different permutation on that. But it wasn't exactly, once you have these, what else do you want? So there was some thinking here. I also think that, there's a lot more DeFi today on Tezos, especially via Etherlink, because Etherlink has very low latency, which I think is important for DeFi. It's very easy to take existing code bases for EVM and launch them on Etherlink. So I think today Etherlink has a modest but reasonable TVL, which is around 50 million. What I'm excited about is using the primitives built in DeFi for doing something that's a bit less circular, because if all you do in DeFi is trade other DeFi tokens, what is it for? Finance has to finance something. And so today in DeFi, in Tezos, you can actually trade things like uranium, like physical uranium. I find that exciting.
I mean, there's so many things to touch upon from what you said there, Arthur. Maybe I'll just circle back. It sounds like you're perplexed about what had some DeFi protocols maintain the liquidity and volumes once they stopped, using your term, bribing the market for liquidity.
Yeah.
Anthony was pointing to before about the community and the ecosystem, or have you not figured out what it was that differentiated these things ultimately?
Well, liquidity is more mercenary, right, than this, especially as it professionalizes. And so, if you're counting on community for liquidity, it's going to be tough. It doesn't have as much intangibles. And even today, so what was the goal of these things? People thought we'll pay for a lot of liquidity. Okay, because we'll have a lot of liquidity, we'll get a lot of trading volume. The trading volume will pay fees. And then once liquidity stops being subsidized, because all those fees are being paid, liquidity will stay there. So you'll have liquidity because it's trading volumes, and there'll be trading volumes because there's liquidity. So essentially, you've created a network effect. People just use that chain because of the network effect. That doesn't work so well once you have liquidity aggregators. People can go to Jumper and choose wherever there's liquidity. Well, maybe sometimes you'll be routed to, actually, Jumper's a bad example because it doesn't spread your trade across multiple pools, as far as I know. But once you have aggregators that just go and get liquidity wherever it is, then in some sense, the network effect gets diluted, because anywhere where there's a little bit of liquidity is going to be hit. It's kind of like, in the US on stock exchanges, you have Reg NMS, and any order has to be routed to wherever the liquidity is the cheapest. And so it's a way for, even if you're a small exchange, as long as you have some liquidity, if there's a big order, a big part of it is going to be executed on a big exchange, but a small part of it might be executed on a small exchange. And you get the same phenomenon. And so you can actually progressively chip at the network effect. So I don't know how viable this strategy is. Again, because the question is, are people users of your chain? Are people users of your DeFi protocol? Are people users of the wallets? Are people users of a DEX aggregator? It all ends up being commodified.
Interesting. So if you don't think transaction fees are going to be, because there's, so much gap between availability and demand,
Yeah.
that it's not going to be a material source of income for the protocols. Where do you think the business model and the commercial models actually lie?
So first of all, I'm not sure about this. So I'm not going to say like, oh, there's no point in trying. I remain skeptical. But that being said, I have let's call it the spaghetti theory of KPIs, which is that revenue is an interesting spaghetti to pull on, because if you pull on the spaghetti, I think you get the whole meal behind it. And so even if somehow revenue is not the thing that makes you economically viable, it's a great thing to maximize, because it's an indication that people are willing to pay to use your chain. It's a very hard to fake signal. Like, you don't even fake it to yourself. If a lot of people are paying a lot of money to use your chain, you must be doing something right. And regardless of what the model is, it's a healthy thing if a lot of people are paying a lot of money to use your chain. Like, you build something useful, and I would say, like, regardless of the business model, the conversion property is like chains which are very useful to a lot of people probably are able to capture more value than that chain that aren't. And so it's a really interesting metric, I think, to focus on and maximize, even if the economics is not necessarily like token burns represent token demand. It could be something completely different. Maybe you monetize the brand. Maybe there's a store of value aspect, and the store of value is reinforced, when the brand is better known, and the way for the brand to be known is for a lot of people to use the system. So I still think it's a very good thing to focus on.
Got it. You're a bit critical of meme coins. My question about this is, I've heard people that are in the protocols are big on memes, see that a little bit as a test net for DeFi at scale, where if blockchain is programmable money, then traditional TradFi systems could migrate onto blockchain. And what memes are is a test net for this infrastructure at scale. What's your view on that kind of thesis?
I mean, people have said this about DeFi before meme coins were a big thing, right? People have said like, oh, isn't DeFi interesting because it's a test run for being able to, to be used for real things and real application. And it's like, all right, so, what's stopping anyone for doing this? I mean, it's good. Like, look, don't get me wrong. If tomorrow I can wave a wand and there's, $1 trillion of meme coins being traded on Tezos, spending millions of dollars in fees every day and doing that, I'm all for it. Like, I will wave that wand any day. There's no sour grapes here. I don't want to say like, oh, I don't have mean and therefore, but I think it will abate. Like, what I take issue with is people who want to make it more than it is. In some sense, like, meme coin is the future. Meme coin is this, it's like, it's a new way to build communities. Like, that is utter bullshit. It's a gambling product. And if people say like, look, meme coin are a very popular gambling product and all people are willing to spend a lot of money for it, and blockchains are a good product to power this new type of gambling product, why not? It's not a gambling I object to. It's a pretense.
Got it.
Where do you see the future in terms of how you would ideally like what you've created to be used? What's the big idea that hasn't come out yet?
I would say the uranium that we've tokenized with uranium.io is close to the type of thing that I really wanted to do. You have some futuristic commodity. I mean, it's not futuristic because nuclear power plants have been there for more than a half century, but it feels futuristic now because they haven't been built for a long time, and now they're being built again. And so if you can power the future and, like, bring markets which are non-existent, like the uranium market is OTCs, it's not like a liquid market for retail and small size, and we're actually like bringing this for the first time. So if you can create important markets, make them happen, I think that's super important. But the thing that that really got me interested in doing this in the first place, like I said, the mission aspect of it is essentially like taking some power away from nation states and putting them in the hands of individuals. So I think financial surveillance and financial controls are a big problem that is going to grow. I think a lot of the fiscal discipline in governments has come only from the difficulty of doing global financial tracking every single transaction. And with technology, the difficulty goes down. So day after day, it becomes easier and easier for governments to track everyone, to control everything that they do. And I would say historically, there's two things that prevents governments to do this. One is popular pressure, perhaps democracy, perhaps if you do bad things, you can put it out. So like, I would say governance is one thing that pushes against governmental abuse, or whatever, like system of democracy you have. And the other thing that pushes against it is practicality, right? There's a lot of laws that the government could pass, but they don't pass them because it would not be practical, right? If the government tomorrow says like, it's illegal to smoke in your own home, very difficult to enforce. They can't go into everyone's home. If tomorrow they had technology which magically let them know everyone smoking a cigarette anywhere at any time on Earth, then easier to enforce. And we are not ready. Like the technology is making it easier and easier to pass stupider and stupider laws. And the governance institutions to push against bad governance policies are insufficient. And so any technology that I would say restore some sovereignty and restore some control in the hands of individuals is quite important to me.
I kind of want to follow up on the uranium example because many would argue that Bitcoin still is kind of like a digital gold alternative. And you've obviously been quoted a few times for saying that people will treat it as funny internet money as soon as kind of the market gets under pressure. How do you make sure that an asset like digital uranium has kind of these long-term fundamental buyers and doesn't fall into the same trap that maybe something like Bitcoin will have?
Yeah. So I had a long interview where I talk about the funny internet money aspect. It's a long, balanced interview where I present different aspects. There's some selective quoting here. I still agree with the quoting. What I talked about in this interview, just to be clear, was situations like, they were asking like, are there institutions buying or are they retail buying? And it was like, I don't know. You should ask this to Coinbase, ask this to an OTC desk. I'm not a Bitcoin seller, so I don't know who's buying. And then they were saying like, or aren't digital assets treasury companies evident of institutions buying? And I was like, no, because it's not like some companies are saying like, oh my goodness, as part of a strategy for the company, we're going to build a Bitcoin treasury. No, they're vehicles for retail. So like they're a wrapper. They're kind of like they're a wrapper for retail buying. So no, DATs are not evidence of that. And when we're talking about the COVID, like good crisis happened and talked about the COVID crisis. So, during COVID, when everyone now has to get confined and might lose their job, I would say the first thing that they did was sell their Bitcoin. They sell what they perceive as fun internet money because they need to pay their rent and their rent is dollar denominated and not Bitcoin denominated. So, and there's still this risk on aspect to Bitcoin. It's definitely not the only source of buyers. I think they are more fundamental buyers who are buying it as a macro hedge, especially now that the dollar is under attack. So there's a real demand here, but that doesn't mean that there isn't this like fun internet demand. So the people hold Bitcoin for vastly different reasons. And there's still quite a big contingent of people who hold it because it's an asset that goes up. And the minute it stops going up, they'll say, my goodness, my analysis was wrong. I was convinced it was an asset that goes up. It is actually an asset that intrinsically does not go up and I shall sell it. So you still have this kind of momentum trading that's very prevalent. Now, onto your question, uranium. I mean, uranium is like a fundamental demand for uranium, which is nuclear power plants. And everyone's building new nuclear power plants, changing the regulations to allow the building of nuclear power plants again. I think the forecast for the demand of energy coming out of a data center is enormous. There's a need of lots of capacity, and I think most of it is going to be solar and nuclear. And solar is fantastic. Like the cost of scaling solar is very, very cheap, and you can scale it right away. So if you're in a situation where you have massive growth and super high interest rate because of the massive growth, there's a lot of value in having your electricity today, as opposed to building a power plant and nuclear power plant and having it in 5 or 10 years. Nonetheless, you still have storage issues with solar, that batteries remain quite expensive, and so there's still a big place for nuclear in the future.
But then just to kind of reiterate, from what I understand, it's just because you have these people that treat an asset that way doesn't mean the underlying asset is in any essence an asset you shouldn't take seriously.
No, of course.
Because from what I understand, you obviously respect Bitcoin a lot for what it is as well.
Absolutely. And the Tezos Foundation is one of the largest holders of Bitcoin. So proof is in the pudding. But again, things are not defined by how people feel about them. Although, actually, you know what? I said that. And then Bitcoin is actually an intersubjective asset. So maybe take it back. Things are somewhat defined by how people think about them. But there's enough people who think about Bitcoin as more than fun internet money to make it more than fun internet money.
Yeah, I mean, if equity markets come off, then I think that, you do see Bitcoin prices and crypto in general take a haircut. But different about paying your rent with Bitcoin to perhaps selling a piece of property, is the liquidity piece, or even accessing your pension fund that might be invested in, debt instruments and equity instruments. It might not be as liquid or easy. There might be penalties and fees from selling these assets. So I think the liquidity piece is another reason that Bitcoin might be sold down, as opposed to it's the perception of its value per se.
The liquidity, I mean, there's quite a bit of liquidity. The question is like, are there people who are fundamental buyers of Bitcoin who are waiting for a downward momentum to catch it? Because Bitcoin has had this cycle. I think we'll see more. I think if Bitcoin takes 20-30%, you're going to see a lot of retail selling. The question is like, are there people on the sideline right now who are saying like, are there central banks who have decided, you know what, as a central bank, we want to buy Bitcoin, but we're not going to buy it now. We're going to wait for the next crisis of confidence and then come in as buyers. So like if you have these people, you'll start smoothing out essentially like arbitraging this type of things in the same way that in a stock market, when a stock stops being sexy, maybe you have Berkshire Hathaway come in and say, wait a second, there's a great deal on this stock and I have a 20, 30-year horizon. And so I'm going to buy it. So the question is like, are there parties like this for Bitcoin? Probably, but I don't necessarily know who they are. Because again, I don't run a Bitcoin selling business.
I mean, you come from a markets background, and so you would have presumably seen people deliberately pushing down the price of a stock or trying to take out people that can only hold out like options positions to a certain level to bring the price down, push them out of the market, and then buy up at a cheaper price.
I have not seen that, actually.
Never.
No, never.
I mean, I think that's fairly prevalent, I would say, especially with some of the people that take options positions very publicly or leveraged positions very publicly on Twitter, trying to gamble on the price of Bitcoin or whatever. There would be people that would want to push the price out, take them out, and then buy up the Bitcoin at a cheaper price. I imagine that
it's possible. The thing with all of these like strategies is that they're all arbitrageable. Like, anything where you feel like, oh, I'm going to do this and then that, you name any strategy like this, and I can find, if you're doing anything that's not like buying based, if you're trying to move the price, essentially, like if you're trying to say like, I'm going to buy and my buying will have an impact on the price, then in all these cases, there's a counter strategy that should negate the effect of what you're doing. And that counter strategy would be saying like, well, whenever I see this happening, I'm going to sell because, there's like someone creating temporary market impact. So if you can predict when people are creating this impact, then you should be providing liquidity in this period of time and you'll make a lot of money.
Yeah.
It's kind of when people were saying like, oh, look, you remember the BARTs? This is like from 2017 where Bitcoin would go like Bart Simpson. I mean, there was a real phenomenon, like you saw them. You don't see them as much today. That's arbitrageable. Like, if you think this is actually happening, you can absolutely detect a BART, like BART short it and then buy back at the end of the BART. And, the reason it doesn't happen sometimes is that because there's not enough like maturity in the markets that you have all these arbitrage in place. Like if you have enough people who are good enough at doing stat arb, those things go away.
Yeah, they're temporary.
And really, like it's not like the closest thing I can think of to what you described was the Jane Street strategy with the options in India recently, which has this weird property where like the more capital you put in the strategy, the more money you are making. So sometimes you just have like bad market design. But even then, what should happen is like basically the other side should go out. One thing I learned in finance early on is, if you have a strategy and you think the strategy is making money and you have like found a way to like automatically make money on the markets, ask yourself like, who's the stupid buyer or who's the stupid seller? If you're like, oh, I can buy this thing and make money, well, who's the stupid seller? Like you have to have overall, I would say financial markets are positive sum, right? Especially if you provide capital to businesses and then they can do economic activity. And so overall it climbs. But anything that essentially beats holding indices to some extent is going to be like zero sum. To some extent, you're going to take the money from someone. If you have found a systematic way to do this and you keep doing it over and over and over, like they're going to stop selling to you or they're going to go out of the market.
Yeah, indeed. What about digital asset treasury companies? What's your view on these?
Well, this is something I thought about like way back when the SEC would not approve an ETF. My thinking was like, well, if you're a staking company and you just own your treasury, you're not a fund. You're not holding a security. You're not a fund. But de facto, you would have something that would be very close to an ETF because even though you wouldn't have creation and redemptions, you could still manage it by doing at the market offering and buybacks. I didn't want to do it because, again, when you had an administration intent on destroying the whole industry, you don't want to be the clever person in the room who's like, actually, I found a way to get an ETF. Then you just like put a giant target on your back. So I started thinking about it again in November last year. But my idea was like, I was wrong about that. I thought that people wanted these vehicles because they were like, oh, it's a nice way to get exposure to the crypto market because you might get access, you might get exposure to a token, and then you might get exposure to like maybe multiple tokens and like a staking activity. And it's kind of like beta in a box, right? You want to all the crypto market, you don't know what to buy. So, buy this company and it's kind of like has a diversified set of activity and it will represent broadly the crypto market. I thought this would be interesting. Doing some market research, this is not what people are thinking. This is not what people want. As a single coin DAT has been far more popular than the other ones. And people have been focused on the metric, which is crypto per share. So it does not seem to stem from people's, I would say, desire for convenience. I think it stems from a delusion that they are necessarily beating the assets because saying like, oh, you have a company, it's going to be better than the assets. And all of the premiums have been absolutely ridiculous and completely unjustified. I also think it comes from desire for leverage. Sometimes I joke that the main product of crypto is volatility. And if the SEC really wanted to destroy crypto, what it should have done is give everyone 100x leverage in their Reg T account. And that's what people want. They want volatility. They want volatile stock. They want volatile assets. And, that explains a lot. That explains why crypto is popular. That explains why perps are even more popular. People want leverage. People want volatility. And so in some sense, when those companies raise money with convertible debt, they build in leverage. So it's a way for people who don't necessarily have access to leverage to get built-in leverage. And it's also, I would say, like, now, I mean, like you take Michael Saylor, who's full of shit. So like, there's a lot of people who I think buy his stuff because they're generally convinced that, he has a magic way of making money. Now, this is not to cast a stone on any digital asset treasury company. I think there's a very reasonable case for doing one. I think there's good businesses and, essentially it's kind of like having a gold mine and you have a gold mine and you say, well, I have a gold mine, I'm going to list it. I'm not going to hedge the gold because people might want exposure to gold. So in the same way, you have a completely normal business, which is like being a staker and validator. And you say, I don't have to hedge my coin exposure. That's fine. But that's not going to deliver on people's expectation that somehow these businesses should be commanding like 100% premium for their talents in deciding when to buy and when to sell.
Yeah. In terms of the leverage piece, I mean, if you're buying into one of these DATs and you're not like an initial like pre-IPO holder, the leverage is already priced in. Like you're actually buying something perhaps at 2, 3, 4 times the underlying assets that sit in the company.
But that's not necessarily leverage. That's just you overpaying sometimes.
Yeah.
The leverage comes from them getting the debt.
Yeah.
But people like the premium. People say that, oh, the premium is good. Look, it has such a premium. That's great. It means it's worth even more than the Bitcoin because it has premium. So your Bitcoin is more valuable in there. And that's crazy. But we've seen some now like trade below. So I think the Joluben East one was below MNAV recently. Now the big question, there's a big governance question, is like, let's say you're Joluben, you hold a lot of Ether. And there's a bunch of Ether in that company. And now the company starts trading below its MNAV. Do you want a company to sell the ETH and buy back share? Not necessarily. Keep it in there. I see we could get a redux of GBTC where GBTC was trading far, far below NAV and they had no interest in, they were collecting fees and then no interest in lowering redemptions. I think it was also like trying to like, it was a bit of a game of chicken with the SEC in trying to get like approved for an ETF. So it's not exactly the same dynamic. But I wonder, and also I think there's limitations in companies' ability to do buybacks on the US stock exchange. You can still do quite a bit, but are they going to sell their assets and do buyback? What will happen? Now, interestingly, the leverage that they have, it caps them on both sides. All right. So it caps them on the downside in the sense that if the value of the assets starts falling too much, they get margin calls from their debt, or they might not be able to service the debt, and that becomes a big problem. If, however, it gets too high, then the debt gets converted. So you're clipping the downside and you basically you're selling calls. You're selling calls and you're selling puts at the same time. So there's a cascade where somehow the assets grow, the shares get diluted, and then all of a sudden people are like, wait a second, this crypto doubled and underlying vehicles didn't. What happened? Why did it get clipped like this? And then people start selling. And so you have like these cycles. I don't know exactly how it will end. I think it will end poorly. I think some will survive because, again, like I said, I don't think there's anything wrong with having businesses which have large crypto treasuries and are focused on doing things. But a lot of these are going to end up washed with the tide because if it starts turning sour, people might not go and say like, oh, this deity is a good one, this deity is a bad one. Or some people will, and they will make a lot of money because they'll be able to like, tell the wheat from the chaff. But it's setting, if setting up to be the next catalyst for a down cycle.
Interesting. Thank you. Arthur, what's your favorite song at the moment?
My favorite song at the moment. Oh, I have a bunch. Let's
You
see.
can share more than one if you'd like.
O del mio dolce ardor by Gluck. It's a baroque piece from Orpheus and Eurydice.
Nice.
I like classical singing.
Amazing. Thank you. I'm sure I can speak on behalf of Jacob and Anthony and say we've really enjoyed this conversation. Just to summarize some of the takeaways and things that we've discussed, we talked about abstracting blockchains and that you're allergic to BS. Some of the things that you were wrong about in the past, such as the importance of scaling.
Yeah.
You're not sure that the dominance of Bitcoin is completely set in stone.
Much more so than 10 years ago. But
Thanks for
still people overestimate it.
Yeah, I appreciate you nuancing that further. Thank you.
My bad, by the way. O del mio dolce ardor is not from Orfeo and Eurydice. It's from Paride and Elena. Not that it matters, but...
Oh, well, it does matter because I will look it up afterwards and listen to it. So thank you.
Okay.
And that you wish you'd stumbled up on the roll-up design earlier.
Yes.
That markets don't necessarily want security. And, if the lottery ticket is the main use case, they don't necessarily care about security. You invented a new word on this podcast called a bondoodle, which was borrowed from boondoggle. And I learned also about spaghetti theory. If you pull on spaghetto, you might get the whole meal.
Exactly.
So yeah, I really appreciate your time, Arthur. It's a great conversation. Thank you so much for joining us.
Thanks for having me.
That's all for this episode of Unblock'd. Please check out the show notes for information on Power Ledger and other contact information. We welcome your comments and feedback, and please hit subscribe wherever you are listening. This podcast was produced by Podcasts Done For You. We look forward to your company next time on Unblock'd.